All right, I want to talk money with Caleb Silver. He's the editor-in-chief at Investopedia. We're going to talk in a minute about the biggest threats that are facing consumers. But first, I want to just show you what's going on in the markets today. And we're going to look at some signs of optimism or some warning signs. Let's take a look at the Dow today. We are seeing a relatively strong day on the Dow. It's been fairly consistent. We're up about 0.5%. Those numbers on the right, we pay a lot of attention to, 150 points, but it's really only 0.5%. We don't tend to get worried about these things until we see movements of 2 or 2.5%. Let's go back. This was March of 2009. That was really what we think of as the end of the recession. And since
getting out of the teeth of the crisis there.
Right, that was it. And so we have seen a relatively steady gains in the stock market. We've actually seen a rocky last year. This is trade war stuff and all of that. But that's the line, and I think that's important to remember. This last quarter of this year was very strong. That's just this part
right
here.
The best quarter in almost 10 years, since 2009. And you can thank the Federal Reserve and lower interest rates for that. And it looks like they're going to hold them right where they are.
In fact,
so
we just heard news that they
that's
might.
What that is.
The government wants interest rates to be lowered. Now, here's the thing. This is what's called a yield curve. Anybody who puts money in a bank account knows that if you put it in for a year, they give you a little bit. If you commit to 3 years, 5 years, 10 years or more, you're supposed to get more interest. This is called a yield curve. Something has happened in the last little while, and the yield curve is inverted, which means the longer you commit your money for, the less you're actually getting for it. What's this about?
This is about a lack of trust in economic growth in this country, which is slowing. It's slowing around the world. The U.S. is facing an economic slowdown, too. It's not that extreme right now, but last week we saw the 10-year yield curve and the 3-month yield curve invert, which basically means I'm less willing to loan you money on the short term for a week because I don't think you'll pay it back. I'd loan it to you for a year or 10 years in this case,
right,
with a better chance of getting it back, so I'll get more reward.
All right, so some people say that this is a concern about recession. Now, recessions in history since World War II, the average time between them has been 5 years and 9 months. You and I remember well, because we worked together in the last recession, that was 9 years and 9 months ago. We are at double the length of time between recessions. So when you take an inverted yield curve and you take this amount of time and you take a market that's been doing that, there are some people who are saying, is there a recession coming?
Yeah, they say we're overdue, it's been too long. At the same time, we've had really low interest rates, and really low interest rates makes loaning a lot easier for businesses. They invest in their businesses. We've had a really strong jobs market. So we may be overdue, but that doesn't mean it's going to be like it was last time.
Right. Last time was a jungle variety recession. This could be a garden variety recession if and when it comes.
And as you know, we don't know we're in it until we're in it or even after the fact. But the job growth has been strong. Wage increases have been increasing a little bit, but there is softness in the market. So we could see one, and the inverted yield curve could foretell that.
This is mortgage rates. Interestingly enough, they're actually not bad. You can get, if you have good credit and a down payment, you can get a 30-year fixed mortgage for 4% right now.
4% is a magic number. That spurs the housing market. It's house buying season right now, going into the spring. People buying homes means people are also going to the Home Depots and the Lowe's of the world and spending on their homes. This kickstarts the economy in lots of ways. So that's a magic number, that 4% and lower. If you took this all the way back, you'd see mortgage rates at 10, 11, 12, 13%. It's nothing like that.
We're just going back to 2010, and you see them above 5%. What do you make of this? Lyft had an IPO today. These are all companies that are IPOing. They're going public on the market. That's generally a sense of strength. There's excitement on the market. Lyft came out. Investors bid it up. Should our viewers, retail investors, regular people worry about this? Should they concern themselves with it?
No, a lot of people say, should I buy Lyft? It's going public. Should I buy Uber? It's going public. The reality is these companies are losing money. Lyft lost $900 million last year. It's growing, and a lot of these companies are losing money. But if this does well, we'll see Pinterest, we'll see Uber, we'll see Airbnb, we'll see some of these other companies going public. It greases the skids for these companies to all hit the public markets. That doesn't mean investors need to buy them now.
Hey, MSNBC fans, thanks for checking out our YouTube channel. Subscribe by clicking on that button down there and click on any of the videos here to watch the latest interviews and highlights. You can get more MSNBC for free every day with our newsletters. Just visit msnbc.com/newsletters to sign up now.